Good morning, everyone. My name is Eric Senft, and I'm a commodity trading advisor. I work with Indicator Warehouse, and I also have my own website at supportandresistance.com. Let's get into our presentation. All right, so what if I told you that there was a way to dramatically improve your results as a trader? Something that was employed by nearly every successful trader, and yet was so easy any schoolchild could do it. What if I told you that by not doing this, you would almost certainly doom your trading career to failure? Would you be interested? Well, if you're like most traders who are frustrated by their lack of trading success, you'd not only be interested, you'd be chomping at the bit to find out what this thing was. So what is so powerful and yet so critical to your success, but so simple to do? Drum roll, please. Yes, it is journaling. Believe it or not, the simple act of keeping a trading journal or a trading log will literally transform your results as a trader for the better. Don't believe me? Well, I'm sure you've heard the statistic that over 90% of traders fail. So if 90% of traders are failing, that means that a mere 10% of traders are doing things right. So what are those 10% of successful traders doing that the other 90% are not? Well, there's one thing that they have in common. They are keeping a trading journal. The statistics don't lie. Out of the 10% of successful traders, over 90% of them keep a trading journal. The other 10% who don't keep a trading journal and are still successful are either naturally gifted traders or just plain lucky. Chances are you're neither. I hate to be the one to tell you this, but if you're like most people, you're probably not a naturally gifted trader, and you're probably not all that lucky. So how can this be? How can the simple act of keeping a trading journal make such a difference to your success? This important fact is what we're going to be talking about in today's webinar. I'm going to show you how to make and keep a trading journal, and hopefully as a result, it will make you a more successful trader as well. So why are journals so powerful? If keeping a trading journal is so important, why don't more people do it? I suppose it can be summed up by these two things. People don't know how to keep a trading journal, and people can't see the value in keeping a trading journal, so they don't do it. The good news is that journaling is not difficult to do. In fact, it's downright easy and requires very little effort. The even better news is that after a little while, when you begin journaling your trades, you're going to begin to recognize certain things about your trading, both good and bad. And this is what's going to help you become a better trader at the end of the day. Keeping a trading journal, it highlights your strengths and weaknesses. It helps you identify different market conditions so that when those market conditions present themselves again and again and again and again, you'll know what to do. Maybe the most important thing about keeping a trading journal is that it's going to give you confidence. Confidence in your trading system, confidence in your abilities, confidence to know how the trade is likely to work out. You're going to get, well, the confidence to take a trade, really. In fact, keeping a trading journal is such a powerful tool, you cannot help but become a better trader because of it. All right, so let's get started. How to journal. The biggest obstacle most people have to keeping a trading journal is that they don't know how to do it. I get this question all the time. People don't know what to keep track of in their journals, or how to keep track of it, or what to do with it afterwards, and so on and so forth. Relax. Journaling is as easy or as complicated as you choose to make it. Remember that your trading journal is your journal. There is no right or wrong here. What is important is that you keep a record of your trades and your decision-making process. That's the heart of journaling. This is where people drop the ball. Before we get into the actual how-to, what you might consider putting into your journal, I should first tell you what journaling is not. Keeping a journal is not merely keeping a list of your trades. That's not journaling. That's accounting. Simply listing your trades will do very little to help you become a better trader. In the past, I've worked with people, and when I've asked them to send me a page from their trading journal, what most of them do is they just send me a list of their trades. They hit the NinjaTrader report button, and it reports all their trades, and it sends it off to me. Well, that does nothing. Nowhere on this list that they would send me was there any notation of why they took the trade. It was merely their entry, their exit, and whether they had a profit or a loss. People do this all the time, and they think they're keeping a trading journal, and then they wonder why journaling isn't working for them. A list of your trades is nothing more than a list of your trades. What is important, what distinguishes journaling from just plain accounting, is that you make a note of why you took the trade in the first place. The why is the most important part in the whole journaling process. Without the why, you may as well not even bother to journal, because you're not going to get any of the benefits. Knowing the why teaches you how to make money, quite literally. Knowing the why you took a trade, clarifies your thinking. It helps you stick to your trading rules. After all, if you don't know why you took a trade, how do you know if you're sticking to your trading rules or just winging it, just shooting from the hip? Knowing the why allows you to learn about the market. It enables you to identify specific market conditions, and believe me, folks, market conditions repeat themselves time and again. By keeping track of the why, you're quickly going to discover what a winning or losing trade looks like when it is setting up. Of course, the idea is that you repeat the winning trades and you avoid the losing trades. Knowing these things, the market conditions, what a good setup or a bad setup looks like, the reasons for taking a trade, this gives you the confidence you need to take trades. And having the confidence to take the trades will put you head and shoulders above the other 90% of traders out there who are continuously losing money because they're stumbling over their lack of confidence. A lack of confidence because they don't know why they're doing what they're doing and what the end result is likely to be. It's a small wonder that 90% of traders out there are losing money. I cannot emphasize this point enough. By knowing why you took a trade, you will quickly develop a pattern. You will see a pattern in your trades, and it's a very simple matter to repeat that pattern. All right, so what are you going to journal? As I mentioned before, journaling can be as easy or as complicated as you choose to make it, but there are a few things that you want to make a note of to get the most from your journaling. These are usually the things that I keep track of in my journal. I'll just go through them briefly here, and you can obviously choose to include other things in your journal. Your journal should include the time and date of your trade. It should also include the tool that you used. I trade using the diversified trading system, which is something that's unique to Indicator Warehouse, and we actually have 3 tools. We have the Hawk Micro Scalper, the Falcon Swing Trader, and the Eagle Trend Trader. And the idea, of course, is that the Hawk, the Falcon, and the Eagle, they all pick up on different market conditions. So I'll make a note of whether I'm scalping or swing trading or trend trading. Of course, you want to make a note of whether you bought or sold, what you bought or sold, the market, your position size, your entry price, your stop loss, your profit targets, the result of the trade, the all-important reasons for taking the trade, and I made a note here that you should always have 2. This little tidbit right here is going to help you be right more often than not. If you have 2 reasons for taking a trade, just a little aside here, if you have 2 reasons for taking a trade, you're going to be right more often than not. If you get in, you're going to find that if you get into a trade where you only have 1 reason for taking the trade, a lot of those trades are going to end up giving you some grief. They may still result in a profit, but they're going to be a lot less predictable than if you can find yourself 2 reasons for taking a trade. And we're going to go into that in just a little bit. Market conditions, it's always helpful if you can make a note of market conditions. And then afterwards, observations, things that you learned, and of course, anything else that you think is important. So this might seem like a lot of information to record, but really it's not. As you journal, you're going to develop your own shorthand so that you can quickly make notes. For an example, I took a page out of my journal. This is back from November 8th. And you can see that it's just a few notes on each trade, and I'm actually recording all that information that we've just gone through. And even though this is from way back in November, by looking at my journal, I can still tell you exactly my reasons for taking each of these trades. So let's just take a moment. We'll go through some of these trades. Here's trade number 1 back from November 8th. So from my journal, I can tell that at 6:42 a.m., because I'm on the West Coast, so that's 10 minutes after the market opened, I sold 1 contract in the 30-year bonds. That's the ZB, with the Eagle Trend Trader. That's highlighted by the letter E. I sold at 149.27. The trade went against me. I eventually got stopped out. That's the SL for stop loss at 150.07 for a $343 loss. My reasons for taking the trade: it was the first signal after a trend change, and it had completed a head and shoulders style topping formation. That's the H&S top. What I learned about the trade? Well, I figured out that I took the trade too early. No trend had developed yet, and that's probably why the trade didn't work out. So in conclusion, in the future, I'll want to wait for a more defined trend to develop before I get into the trade. Let's take a look at trade number 2. Trade number 2, 6:46 a.m., I bought 2 contracts in the mini Dow, that's the YM, with the Hawk Micro Scalper. So that's the letter H there, capital H. I bought at 129.26. I eventually got stopped out at 128.97 for a $290 loss. So what were my reasons for taking the trade? Well, first, it was a first micro-macro crossover signal. That's what the 1mmXO means. This is normally a high probability signal, and it's something that's unique to the Hawk Micro Scalper. So I can just use that shorthand. I'll know immediately what it means. I also thought the market was in a retracement mode because crude oil was on the rise. Crude oil and the Dow have a tendency to move together. Not always, obviously. So what did I learn about the trade? Well, Normally, I'll make my observations, I'll highlight them with a star to make them more obvious. And you can see I was quite upset with myself because I was buying and there was a downtrend here. So that's obviously why the trade didn't work out. The market had a trend and I chose to go against it. So the conclusion, if there's a defined trend, stick with it. Take a look at another trade here. Trade number 3, at 6:49 a.m., I bought 3 contracts in the NASDAQ, that's the NQ, with the Falcon Swing Trader, that's the capital F. I bought at 26.22.75. The trade hit my profit target, which I used the symbol pi for profit. I think that goes back to my statistics class many, many years ago. At 26.27.75 for a $300 profit. My reasons for taking the trade? Well, it was the first signal after a trend change, and I bought it on a second push higher, which, again, it's one of our entry signals with the DTS system, but what it did is it reconfirmed that the buyers were serious by getting in on the second push entry. So what did I learn? What was my conclusion here? Well, the first signal in the Falcon Swing Trader and the second push entry are both good strategies to follow. So this is a trade setup I definitely want to be on the lookout for in the future because I know it worked. Let's take a look at trade number 4. I actually have trade number 4 and trade number 5 here. Trade number 4 tells me that at 7:07 I sold 2 contracts in the NASDAQ at 26.12 with the Hawk micro scalper. And I closed them out at 26.09 or 26.0950 for a $100 profit. My reasons for taking the trade, it was a first micro-macro crossover and a failed buy. That's what the capital B is for. And that gave me the confidence to sell. The market was also in a defined downtrend at this point, and that's what the DT is. The conclusion, what did I learn about this? Well, that it reconfirmed that the first micro-macro crossover, the 1mmXO, is actually a strong strategy with the Hawk micro scalper. And waiting for the failed buy and sticking with the trend contributed to the trade's success. So once again, I'll be looking for a similar setup in the future. We can just quickly go over the next trade, which occurred at the same time in a different instrument, essentially the same thing. At 7:07, I sold the Hawk, I sold the mini Dow with the Hawk at 128.90, and eventually found my profit target at 128.80 for a $100 profit. Once again, the trade scenario was the same. It was a first micro-macro crossover signal, a failed buy, in a downtrend. So I know when I see those things happen that I have a good reason for taking the trade. So here's only one page from my trading journal. Can you see how even looking back at just a couple trades, how much information I was able to capture about the market? Information that would have forever been lost if I only kept a list of my trades. What would it mean if it simply said, sold NQ2 at 26.12, bought 2 NQ 26.0950? What does that mean? Okay, it resulted in a $100 profit. It means absolutely nothing. But by jotting down a few notes why I took the trade, I have an invaluable resource about what is working and what is not working. And like I said, this information, if you don't make note of it when it's happening, you're going to lose it forever. So I hope you're beginning to see why journaling can be such a powerful tool. So when you're journaling, there's 2 ways to go. You can either do the manual method or the automated method. I'm going to touch on both of these just briefly here. Perhaps the best thing about keeping a trading journal is that you don't need to make a huge investment to do it. A pen and a notebook are really all that you need. You can see from the photocopy of my journal, I like to use a spiral bound notebook for my journaling. That's just so I can have all the information in one place. But you can use any type of format that works for you. Personally, I'm a big fan of handwritten journals. While there's absolutely nothing wrong with typing a journal or using an online journal service, the act of writing your journal seems to ingrain the trades and the results deeper into your brain. Personally, I believe that you'll experience the benefits of journaling faster if you choose to write a journal by hand rather than using some other format. A handwritten journal is easy to do and can be done real time while your trade is underway. You can record all the information you need about the trade in only a few seconds while everything is still fresh. Then when the trade completes, you can make a note of the pros and cons, why the trade worked out, why you think it didn't work out. When I have a losing trade, I always try to find a reason for it. It's probably going to be fresh in your mind why the trade did not work out. Something's going to be, you're going to watch it unfold, something's going to be coming up in the back of your mind saying, oh, darn it, Eric, you sold into an uptrend, or you should have waited for this signal, or you should have done that. Make a note of it. If you do choose to use an automated service, you can still reap the benefits of journaling. Just make sure that you keep track of the why. We have a tool, actually. There's a website called TraderView, which is a very good journaling service. It's an online service, and we've actually developed a journaling gadget, a tool called JournalLink, which will take your trades from NinjaTrader and automatically submit them to TraderView. Now, the nice thing about that is that TraderView and the JournalLink plugin that we have does all the hard work for you. It takes all the data, submits it, keeps track of it, keeps track of the numbers so that you can concentrate on recording the important stuff. You can concentrate on recording the why you took that trade. But remember, that's important. If you choose an auto journaling service, remember, you have to use it to make it work for you. Don't fool yourself into thinking that you are journaling simply because you're recording your trades. Recording your trades without making a note of the why behind the trade will do absolutely nothing to improve your trading success. It's important to make journaling easy for yourself. If it's too difficult, you won't do it. So keep it simple should be your journaling mantra. But it's the most important that you do it. Journaling does work, folks. I guarantee you will be impressed by the results. I guarantee it will make you a better trader. I know I'm beating that horse to death, but I cannot overemphasize that point. And now, for something completely related, we're going to talk about back testing. This is kind of the 1-2 punch of making yourself a better trader. This is your self-improvement process, and you will reap the benefits almost immediately from doing this. This is not something that you need to do and hope that 2 months down the road you're going to start seeing a benefit from your efforts. No, this is stuff that if you do today, you will start to see benefits tomorrow. So what is backtesting? Well, backtesting, as the name suggests, is to backtest a trading strategy by using the chart's history to see how your system would have performed had it been used real time. By back testing, you can review, you can change things, you can improve your trading results before you ever put real money at risk. Back testing allows you to optimize your signal and find out what works and what doesn't. There again, giving you greater confidence to take a trade. Now, you probably won't be surprised to know that most traders don't backtest. They think backtesting is too much trouble, and therefore they just don't do it. Is it any wonder traders struggle and lose money? The benefits of backtesting far outweigh the time and the effort required to backtest your system, and it's much easier than most people think. While it's possible to backtest your system manually, I strongly recommend using a backtesting program. Indicator Warehouse has one called Profit Finder, and it makes backtesting quick and painless. In fact, it's actually kind of fun to backtest with Profit Finder because it's almost like playing a trading video game where the objective is to, well, obviously maximize your money. But regardless of whether you decide to backtest manually or with a program, backtesting is an investment that will pay you dividends immediately. And like I said before, journaling and backtesting, you don't have to wait for weeks or months to reap the benefits. You will see results the very next trade. All right, so what to backtest? When you're backtesting, it's important to remember these three things. You have to accurately record your results. You change only one variable at a time. Then you test and you repeat the process until you tweak your system so that it maximizes your profitability. Problem is that most people tend to only backtest their entry signal. While testing your entry signal is important, you should also try to backtest your stop loss strategies and profit targets. This way you're going to be able to determine which stop strategy is most effective, what the size of the stop should be, whether it's to your advantage to have a running contract in play or go all in, all out, or a combination of the two. You'll only find these things out when you actually backtest. When you're backtesting, you're also going to be able to determine your winning percentages as well as your overall profitability. And these are keys. These are keys to helping you analyze your system, analyze your strategy, and be able to make better decisions about how you want to trade. By backtesting, in fact, what's interesting is by backtesting, you may discover that you can actually make more money by sacrificing accuracy. And I'll get into that in just a moment. All right, so how to backtest? The easiest way to calculate your results and to give yourself a decent sample size so as to smooth out the statistical inaccuracies is to backtest 100 trades. Now, I know it seems like a lot, but really it doesn't take you that long to backtest 100 trades. For most day traders, you're going back maybe 10 days, maybe 15. You're probably doing 100 trades within certainly certainly the last 20 days for most day traders, but you're probably only going to need to go back about 10 days. Besides, by doing 100 trades, you can easily calculate your win-loss ratio, which will give you an indication of how effective your trading signal is. I bet if I ask most of you in the room today, you have no idea what your win-loss ratio is. Do you? But once you know your win-loss ratio, you'll be able to make some decisions. Your win-loss ratio should be no less than 50%. Believe it or not, with proper money management, it is possible to make money even with a 50-50 system. However, if your system is less than 50%, if you have less than a 50% win ratio, it's time to tweak the signal or find a new signal so that you can get better results. It is very difficult to consistently make money with less than a 50-50 signal. Ideally, your entry strategy, your entry signal, should post a win-loss ratio in the neighborhood of 55 to 75%. If you can develop your system to return those kinds of results, you're going to be well on your way to making money. Now listen, folks, it's really important that you be honest when you're calculating your win-loss ratio. If you're dishonest here, you're only cheating yourself, quite literally. You got to put your ego on the shelf, resist the urge to cheat, and, say, oh, I really would have taken this trade that turned out to be a winner, and I really wouldn't have taken that trade that turned out to be a loser. No, don't do that. You won't be able to cheat your results when you go trading with real money in real time, so don't cheat now. You're going to save yourself a lot of money in the future. All right, so once you're satisfied with your entry signal, it's time to test your stop-loss strategy. As I mentioned, most people stop at the entry and they think they're ready to go. No, you're not. Select a stop strategy, run it through your 100 trades, and record your results. Substitute the next stop strategy, do it again. Compare your results. Do this as often as required to find the best stop strategy for your system. Your stop strategy will affect your win-loss ratio, moving it up or down. As before, you don't want to get your win-loss ratio to an area where it's running less than a 50-50 system. Once you've settled on your your entry and stop-loss strategies, it's time to test your profit targets. Compare your results if you're going all in, all out, with a strategy where you have a trailing stop to one where you run the whole position. As before, different profit targets and different profit strategies will have varying effects on your win-loss ratio. All right, so when you've done all that, congratulations, you now have optimized your system so you know the optimal entry, the optimal stop strategy, your profit targets, what's going to be your best profit target, and you've just given yourself a huge chance of success. By doing this exercise, you have a huge advantage over the other 90% of traders out there who don't back test their systems. And believe me, folks, it is not as difficult as it sounds, especially if you use back testing software. I already mentioned the Profit Finder. I believe that we have a special offer for Profit Finder, which we'll talk about at the end of the presentation, but having a backtesting program like Profit Finder makes monitoring the changes to your system, like changing stop strategies, changing profit targets, a snap. I don't recommend a lot of software to folks, but if you're serious about making money, this is a tool that you should consider. Profit Finder automatically recalculates your results in a matter of seconds, and it allows you to compare your strategies quite easily. With Profit Finder, you can optimize your system, your entries, your stop loss, and your profit targets in less than an hour. And the nice thing is, if you're using a optimizing program like Profit Finder, because it takes all the work out of backtesting, it's actually possible to optimize your system for each of the markets you trade and to keep adjusting them when market conditions change, because conditions will change throughout the year. After all, what may have been optimal 6 months ago may not be optimal now. But with a tool like Profit Finder, and an hour of your time, you can easily optimize your trading system or markets, keeping you up to date with what the current market conditions are. All right, so in conclusion, the most important thing about backtesting, like journaling, is that you do it. I can tell you from personal experience that I have seen the results of backtesting. Oftentimes, it's not the system alone that is the problem. Rather, it's a combination of the entry, the stop loss, and the profit target that make or break the system. You know, I see traders all the time. They're so focused on their entry that they jump from one trading system to the next, never realizing that it's not necessarily the system or the signal that's the problem. That it's actually a combination of variables that is giving them the poor results. For example, and this is the truth, through back testing, I was able to take a system that was losing $3,000 over the 100 trades, and by testing the changes to the entry signal, to the stop strategies, to the profit target, I was able to flip it around so that the system was actually returning $3,000 and it had an 80% win ratio. Or there was another system that I discovered I could actually return another $1,000 in profit by lowering the accuracy of the trades from 70% to 60%. So I actually dropped my win ratio, but I made more money. And how did that happen? Well, it's because I adjusted my stop. By adjusting my stop differently, it actually got me stopped out a little bit more often because my win ratio went down. But at the end of the day, I was putting more money in the bank. Of course, none of these discoveries could have been made if I didn't take the time to backtest and optimize my system. And like I said, chances are very strong if I ask any of you in the room today what your win-loss ratio is, what your best stop strategy is, what your optimal profit target is, very, very few of you would be able to answer that question for me. So if you're serious about making money, you've got to take the time to backtest your system. Separate yourself from the 90% of losing traders by taking the time to perform this simple exercise. It is not difficult to do, folks. Really, it is not. Remember that when you start trading real money, nothing's going to change. If you cannot make money trading in hindsight, you're certainly going to have a really hard time turning a profit when it comes time to trade real time. All right, there you have it, folks. I've shown you what you need to do. 2 very simple things that will dramatically improve your success as a trader. Journaling and backtesting. The rest is up to you.